from today's perspective, the next 12 months EPS based on my model is 2.25. To understand valuation, it's always forward looking. So all this historical stuff, nobody cares at this point. Yep. And it's all about forward looking earning. Now we to Tesla's. So how can the stock be so high? And you see it here in this chart, because yes, 2025 I forecast just under $2, not outstanding, but then in 2026 we get already to $2.6, so it's a massive increase, and it's even ahead of last year, and just a bit below 2023. But then it really takes off in 2027, and then it goes bonkers in 2028. Wow, this is kind of the key reason, because there's a huge carrot right now dangling in front of like in Tesla's future, and that's why the stock is trading so highly. Because when you then think about this, okay, what does this mean in terms of share price appreciation? This is where we then have to go to the next step. I now take these.
Yeah. Anyways, from $2 per share to $8 per share in 3 years. That is.
Yeah, exactly. That's the crazy thing about it.
It's very rare to find an analyst who covers Tesla stock, who does deep dive research and creates detailed spreadsheets to back up their claims and forecasts. Today, we get the chance to speak again with AJ. He'll walk us through Tesla's outlook and will show us when financials kick in and why. He'll then explain what it means for Tesla's valuation and stock price forecast. As a treat, AJ will also walk us through his Tesla Robotaxi report. This is definitely a must-watch for all Tesla investors. AJ has a background in finance and physics. Before he became active on X, providing independent financial research, he retired from investment banking, where he advised public companies on mergers and acquisitions and other capital market transactions. AJ will be speaking to us off camera since he prefers to stay anonymous. Welcome back on the channel, AJ. Appreciate you.
Hi, thanks for having me.
We did a really good show last time. I don't remember when it was, but you came with detailed forecast, and I think you were pretty accurate in what you were suggesting was about to happen, not only in the financials, but your stock price. So what you do is you are showing earnings, and what you predicted was that Tesla's stock will actually rise because earnings will be pulled forward from 2026 by the end of 2025. So we'll catch up with you to see where you're at. But your predictions for the stock price, even in the last several months, have been fairly accurate. So I wanted to bring you back on here. I've got this post that you made recently, just last week, and you said, hey, you nailed your short and medium-term trading predictions. So you had predictions for the earnings, you had predictions on January 30th, and you had one in February. So let's start with the January one. You said, in late January, I predicted that we could see weakness into April. That's exactly what happened. Tesla traded down 45%. In February, Tesla was 200 at the time. You predicted Tesla would soar to 290 by year end, and this prediction nailed it. Oh, sorry, this was February 2024. Okay. Yeah. And then in earnings, on March 29, I predicted that we should see the stock strengthening after the first quarter print. And that's what happened. Tesla's up. So you've been kind of getting a sense of not only the long term, but also the short term. Yeah.
Yeah. I covered the stock for over 10 years. So I learned one or the other thing.
Gotcha. All right. Well, let's get started with your presentations.
Yeah. So basically on this first slide, you basically see the final outcome of what I'm about to present. And so what you see here is, so the gray line, this jagged line, is Tesla's actual share price. And here I marked the Trump rally that we saw after the Trump victory, where Tesla soared to, I think, $488 per share. And then obviously stock came down with all the bad news that happened, etc. We don't have to go through that right now. And then the other lines that you see is actually based on Tesla's historically observable multiple and earnings, and also once we run out of Tesla earnings, so this is on real Tesla earnings, until we don't have Tesla earnings anymore, and then I supplement missing earnings with my forecast, because for a multiple, you always have to have an annual earnings number. And so this moves from this period. This is all based on Tesla's historical numbers. And then as we approach 2025, we run out of Tesla's next 4 unreported quarters, and then I add my forecasts to construct a rolling 4-quarter earnings number. And the result, what you see is here. So I use my earnings forecast, and then I apply observable multiple range, and we'll get into this into more detail in a bit. And the result is what you see on the slide. And so this wide gray shaded area is the implied path of Tesla's share price based on this methodology. And the green lines is within 1 standard deviation of Tesla's historic multiple, and the red lines are within a market 1.5 times standard deviation of the multiple. So basically, when you look at this, you can see that it basically showed you when you should have bought Tesla. For example, right here in last year, April, it crossed beyond the it crossed outside 1 standard deviation of the normal trading range. So this marked a good buy opportunity. And during the Trump
Overshot
rally,
it.
it was like quite a aggressive rally, and you could see that this was kind of an outlier event when you look at it historically. And so this is kind of the high level mechanics. And now we get into the detail how all of this works. Ultimately, you need 2 components to construct something like this. One, you need an earnings forecast that is 98% of the work, and then you need to look at Tesla's multiple. So maybe we start easy, and we first look at Tesla's multiple, and for that
Okay.
we look at this chart. So this chart is the share price again. And so what do the different colors mean? So first, the gray share price is for the time period for which we have Tesla's actual quarters for the next 12 months. So when you look at the specific date, this share price looks at the earnings for the next 12 months from that point in time. So it looks in the future, and because it's using Tesla's future actually reported earnings, it's what I call the true PE multiple. So it's not based on analyst estimates or consensus estimates, and it's like what it's so the
What actually
consensus.
happened. Yeah.
Exactly. And you can think about it in a simplified way. If the consensus was 100% accurate, that would be the multiple that you would get. So this kind of, the reason why I go through this exercise is to get kind of a base level where a stock trades. I do this for all the companies I cover. And what you will discover, and by the way, also this is my professional career before, and what you discover that companies in the same industry selling same products, whatever, there is not one multiple. They always have slight differences or bigger differences. Like in Tesla's case, there's a giant difference between Tesla and companies that a lot of investors would consider peers. I would argue there isn't really a peer, and so you cannot just do a benchmark. So typically, professional investors would look at a comp set, a comparables company analysis, and they would derive multiples. And then they would apply to Tesla to find out whether the company is over or undervalued. But this doesn't work in Tesla's case because you don't really find peers. And that's why you have to do this analysis, and you have to look at where the stock traded. And the stock, the key point is that the stock has been trading at very, very high multiples for a very, very long time. And the naysayers would say, oh, the stock is overvalued. I beg to differ, because ultimately the market is right and not you or I or anyone else. Ultimately,
Mhm.
it's what the market is willing to pay for it. And whether you call it Tesla hype, Elon hype, or whatever, it doesn't matter, because the fact is that the stock, and this is what this chart shows, has for many years been at a very, very high multiple. So when we look at these, and
Mhm.
I'll explain in a second what these green and red lines mean, um, the stock has been at over 70 times forward
70x. Mhm.
earnings,
Yep.
not LTM. So last 12 months, it's always based on forward earnings.
Forward. Yep. Forward 12.
Forward means always the next 4 unreported quarters.
Yeah.
And unless you specify you're using a 2-year multiple, which you can also do, but the most commonly applied multiple by investors globally is um, is the 1-year forward. And the reason why I can speak about this confidently is because I worked on IPOs, and in
Mhm.
IPOs we always asked investors what valuation methods they use for the bids, and when you do this. Investor roles, and ECM bankers know this stuff inside out. People
Mhm.
always use 1-year forward multiple. But anyways,
Yep.
so the point is, what we established here on this page is that Tesla simply has a very high multiple. So if you want to do any type of valuation work, you need to consider this high multiple. So that's why I'm not coming up with my own multiple. I just look at Tesla's historic trading performance, and then I pick a a time period, and what I do is I look at the last 12 months.
Mhm.
You could debate, should you have 3 months, should you only look at the last 3 months or the last 5 years. My argument would be, if you look at a very short period, 3 months multiple, that this might be, there's a lot of volatility, a lot of sentiment change. This might be too short. For example, if you had done this during the Trump rally,
Right.
you would have been completely off. But equally, if you pick a very long time period, like
Mm.
5 years or 10 years,
Mhm.
the stock goes through different stages. It's like a human growing up. It's
Yeah.
first
Totally different.
toddler,
Yeah. Totally
kid,
different company.
teenager,
Yep.
and becomes
Gotcha.
adult. It's, I think, similar with companies, and as they grow in size,
Mhm.
etc. So you want to have what I would call a recency bias, and that's why you should not go too far back, and that's why I go with a 1-year multiple. And then what I do is I look at the median multiple, and I use the median
Yes.
to avoid the extreme outliers that you
Yes.
capture with the average. Although the
Yes.
problem is not that great, because 1 year has quite a few trading sessions, but still the median gives you a better result. And what you see on this chart is again kind of the same methodology I explained before. I look at the median. This is the center blue line that you see,
No
and
way. It's
that median
120.
is
Wow.
exactly right. It's
Wow.
120. And we will get in the second part, when we talk about how you derive earnings, we will get to why it's so high. And because like if we step a bit back to get everyone on the same page, 120 is extremely high for any stock. But we'll get to why that
Okay.
is, and why this is actually not a huge concern to me.
Gotcha.
And so and then the green lines, again, they indicate one standard deviation, and the red
Mhm.
lines, again, they indicate 1.5 standard deviation. And the reason why I use 1.5 standard deviation, this is statistically a quite rare event, and this is also confirmed by this chart. And please note, this chart goes back over several years, and you
Mhm.
see that the stock only twice
Mhm.
exceeded to the up and downside 1.5 standard deviation. That shows you how rare it is. Um, so with that out of the way, so we established now how you can think about the multiple.
Mhm.
Now we need the second component, the earnings, because when you multiply the earnings with the multiple, you get your share price.
Yes.
So now we need the second half, and the second half is basically where we get to this. So this is the table of contents of my models, and don't worry, we're not going to go through each of these things.
Wow.
So what I did is, and I just, for some people might be curious how all of this works, I show you the machine room. So I built like a huge Tesla model where I tried to capture everything management talked about. This has basically thousands of line,
Yeah.
and so this is only the revenue model. the cost model of all the business
Mm-hmm.
lines, but this is not the full cost model because there are details models behind it. This is just the this is just the Robotaxi model, the cybercab model. We talk about this towards the end of this presentation, the cost model for operating expenses, and then this is the work you have to do to translate the earnings per share into a nice looking chart that we just looked at, but it's just a machine room. We don't need to worry about it. So let's jump right into sort of
Yeah.
the
Can we
outcome of
just
all of it.
yeah, pause for a second? First of
Yeah.
all, AJ, I just want to appreciate you for the work that you put in. This is the most amount of work I've ever seen any Tesla retail analyst do. Thank you for doing that. And folks, if you want to have access to his information, you should subscribe to him. He's worth, I think it's $5 a month. I think you charge. It's worth that subscription of anyone because this is the value you're going to get. These charts, these graphs, these forecasts. You can see this. So thank you so much, AJ. Keep going.
You're welcome. I just do it for, my goal was to kind of help level the playing field for retail investors, because I come from Wall Street and I always found it unfair,
Mm,
because I knew the information institutions have access to, and I
mm-hmm,
always found it unfair that average people don't have that. So I wanted to bring some of that to every person basically on the street who
mm-hmm,
takes the time to go through these materials. And yeah, so anyway, so basically after you did all this work, all this modeling work, and you bring it all together, here on this first slide, we look at the revenue stream. And this already explains partially why the multiple is so high. But of course, revenue is not earnings, but we'll get to it. And before we discuss or look at the numbers, please take a look here on the right-hand side, because this breaks down basically Tesla's entire current and probably the business over the next 2 to 3 years, for which we have at least some management guidance, which is kind of tangible. For example, Optimus, we can touch Optimus. They're walking around. Tesla gave us guidance, a certain number of units, etc. We know it's coming. But things where I have no management guidance, for example, the inference opportunity that is embedded within all cars. I have not included this yet
right.
because
Yeah. It's not a business
management
yet.
has not.
Yeah.
Elon only at very high level
Mm-hmm,
talked about it, so I have not included those things. But when you go through this list, of course, I include the automotive, I include FSDs, subscriptions, automotive leasing, of course, regulatory credits. You have to include it; it's part of the business still. And by the way, this is not only for US business, it's a global thing. So even if the current administration kills the credit in the US, only approximately 1/3 is being lost because the rest of the credit comes from other jurisdictions. I include the Semi. This is also a tangible product. It's driving around. It's coming. Tesla is building a factory. Energy generation and storage, of course, it's great business. Then robotics. Robotics captures Optimus, but is also kind of the placeholder for the segment in the future, because Optimus will not be the one product. There will be different products, and Tesla has talked about this already. I also included the owner ride hailing. The owner ride hailing, I just briefly explain, is when a Tesla owner contributes his or her vehicle to a Tesla managed ride hailing network. Tesla takes a cut, and the owner takes the remainder of the revenue. I also modeled this out, considering that not the entire fleet can run FSD, etc. But anyways, and then the Tesla ride-hailing network, or Tesla ride-hailing segment here. This is where the Cybercab sits. But of
mm-hmm,
course, Cybercab ultimately will also develop or evolve, I should say, into a bigger product line. We know the Robovan or the
mm-hmm.
Robovan, however you want to pronounce it, and there will, I'm sure there will be other products. And and then ultimately, of course, the services and other business that captures Tesla insurance, paid charging, vehicle maintenance, out of warranty repairs, yada yada yada, all the other stuff. So this capture, so all of this, what I just walked through, is captured in this model, and the revenue line that is shown in this chart is ultimately the summation of all of these different business lines. And when you look at here at these numbers down here, so first of all, let's look at 2024. So the baseline is basically 89 billion in revenue. My bottom up forecast expects a slight decrease, 3% decrease this year, before we see a quite strong return to growth in 2026, and then a massive growth in 2027, and then more growth in 2028. So Tesla is very backloaded in a way, and this in significant parts explains the high multiple, because it's not only the revenue, but also you have to keep in mind that the Tesla's future AI business lines, they are high margin business lines for the most part, and that's why each incremental dollar of revenue provides a lot more earnings, and ultimately it's earnings and not revenue that is driving valuation. So with that out of the way, let's maybe jump
Yeah.
to.
First of all, I think you said 89 billion, but it was actually 98 billion in 2024.
Sorry, I misspoke.
Yeah, and that's what you meant, 98 billion. But yeah,
yes.
it's great because I like this very much. I think it's conservative. 2025 is pretty well flat. In fact, even a smaller decrease in that. But then 2026 also a little flat. It's still only just 110, and then it really doubles by 3 years. And so that's what people can understand. It's going to double by 2028.
But there is more to it. You can't just look at the revenue number, because you're missing the margin picture. So this is and also this is an alternative version of this exact same chart. But here I just split the revenue into the different buckets. I didn't add the labels here because it would make the chart too busy. But it's ordered in the same order as these businesses, and you can see there are some business lines that contribute a lot of revenue, like obviously the automotive business, and there are a bunch of business lines that are kind of not needle move in terms of revenue. But again, you always have to look at it in terms of margins, and this is where this becomes more interesting. So the gross profit reflects a business's margin. For example, if you're very high margin, you don't need very much revenue, you get a lot of gross profit. So the name of the game is really gross profit. And so when we look at gross profit, so in 2024, Tesla generated 17 billion. I expect a slight actually, when I say I expect a slight decrease, is actually wrong. The outcome of my assumptions, my bottom-up analysis, produces a result that implies a 10% decrease. This is the proper way to say it, just to be clear. It's not like I'm having revenue numbers and I plug some margin assumption and this is what comes out of it. No, it's much more involved. And just to be very clear. Anyways, and then in 2026, we return to quite material growth. 21% is nothing to, this is quite substantial, but you always have to keep in mind the forward-looking nature of earnings. So you might say, oh, from May's perspective, 2026 might not be that amazing, but if you look at it in terms of like 1 year forward, like May 2026, you're already touching 2027 in terms of the next 4 unreported quarters. This is a very important sort of concept to always keep in mind. Otherwise, if you don't understand that forward-looking nature of earnings and markets, you're always kind of behind. Like, for example, a lot of people have a bearish outlook for 2025. But the point is, by the time we reach the end of 2025, the market is pricing in 2026. So that's the crux. And so basically coming back to this, so when we split the gross profit, now this is much more meaningful than the revenue split. At first glance, it might look a little similar, but you can see that all of a sudden there are a lot more buckets that add sizably, while before you couldn't barely see them in the revenue split. But we get to this in a moment. And then when you then kind of rank all the businesses, you sum up how much gross profit they generate,
Hmm.
then this is one way you can show this. So in 2025, I project that the auto business, excluding leasing, generates about 7.8 billion in gross profit. And then the energy business will be number two. Then regulatory credits will be quite important, because you have to keep in mind regulatory credits is pure profit. So they have a small revenue impact, but a massive gross profit impact. Then you have auto leasing, service and other, and then FSD subscriptions. So I know some people will be surprised. Oh, why is it so low? We can get into the assumptions later, but I just believe me, a lot of thought went into this, and the thing is, when people pay $100 a month, this is basically per quarter
Hmm.
$300 in
Yeah.
profit, and
Yeah.
this is the and you need 20 subscribers to make up
Hmm.
for one vehicle sale in one
Yeah.
quarter,
Yeah.
because the gross profit on one vehicle sale on average is around about 6,000. Okay, so the FSD subscription is nice, but it needs to scale before it makes a big impact. And then when we go to 2026, you see how the picture slightly changes. Auto improves. This is significantly driven by a combination of factors we can discuss later if we have time. And then over time, 2027, you see auto is still very important, because it also includes cybercab. The cybercab, Elon said, is not only for Tesla's ride-hailing fleet, but it will also be for sale. And I think that will be a very attractive product, because not everyone wants to ride in a taxi all the time. People who have money, who have homes, and people who have homes right now, most of them already have a garage. So you might as well use it. And I'm sure a lot of people, even if you have like perfect ride-hailing network, they still like to have their own vehicle, because cybercab will not be that expensive. And the way I modeled this is that cybercab has obviously no steering wheel, no pedals. So when Tesla sells a cybercab, it automatically sells the subscription. So it's bundled effectively.
Hmm.
Just to make this very clear. And when Tesla sells a cybercab to a customer and sells a subscription to the customer, that revenue is reflected in FSD subscription. Just to be clear, so there's no double counting here in this model. And
Hmm.
so I hope this is helpful, that people can separate the two, because there are two ways to look at cybercabs effectively. And then when we look at 2028, becomes more interesting, because now a bunch of the other businesses, they scale and become bigger and bigger drivers. And I'd like to point out the ride hailing network. And we will look at the assumptions in the second part of this sort of presentation. In 2028, I estimate the ride hailing network will have scaled to basically to have become Tesla's number two largest business, but the auto
Hmm.
business still remains important. However, the the thing that we still cannot capture with gross profit is like overall profitability, because the the auto business um, requires a lot more SG&A. So this is down here. Here,
Hmm.
operating expensive, and operating expenses comprise of two primary components. One is research, and the other one is basically all the admin costs. So selling, general, and administrative expenses, and And because we are looking at gross profit, we have not considered this element yet. Because if we knew for each business the research and SG&A cost, this ranking would look completely different. Because the auto business, a lot of the gross profit from the auto business is consumed by quite significant research requirements and SG&A requirements. Because when you think about a car, you have to develop thousands of components. It's not only the battery and
Right.
drivetrain, interior trims, seats, yada yada yada. So that a lot goes into it, and I study auto companies quite a bit. So there's a very high ongoing R&D requirement, and this is also the primary reason why basically no small automaker is sustainable, like in terms of generating positive free cash flows, because the R&D is just too massive, and the R&D is trending up. So with that out of the way, this is kind of the OPEX picture underlying my modeling. So this chart combines the forecast R&D spend and also the forecast overhead expenses. And what you see here is in 2024, Tesla spent 10 billion, excuse me, on OPEX, and I expect it will slightly increase in 2025. And part of the reason is Tesla cranked up to record highs R&D spend, and so Tesla is really doubling down on all the initiatives that they're trying to launch. That's clear from the numbers, and this is reflected in my forecast. While Tesla cut back on basically overhead expenses, and then in 2026 I expect more growth to continue, simply driven by the scale of the business, and I'm sure Tesla will continue spending quite a bit of money on R&D, and then it will just increase from there. This is typical for all these types of technology business. For example, if you look at Meta, Google, etc., they have these AI projects. Their R&D spend is also going through the roof. And I'd like to point out this is different from compute, because compute sits in capex and it is not directly reflected here. Although there's a bit of technical overlap, but it's kind of a detail we shouldn't go into it because it's just wasting time. So here is then the operating profit, and this is now we're getting very close to earnings, because operating expenses takes all the revenue, takes out all the cost, takes out all the operating expenses, and now you have basically what is the business generating on an operating basis before you consider financing and some other non-operating items. And in last year, Tesla generated 7 billion operating profit, was down 20% compared to 2023. It was primarily driven by discounts, because the auto market globally right now is under enormous pressure. I review all the top automakers globally, over 35 companies, and the cash flow is collapsing. I discussed this in detail in my research, and so everyone. I just want to make this clear: everyone is massively discounting, and this is driving down the profit, the operating profit. I expect 2025 to remain very difficult year in auto, because of this price war. And that's why this is the primary driver why the operating profit will see a decrease in 2025 based on my forecast. People might wonder, oh, what about energy and storage? Yes, energy and storage will be growing and will be contributing positively in 2025, of course, but it's simply not large enough, even despite the strong growth, to offset the pressure in the auto business, which is enormous. And again, this is an industry-wide thing. This is not Tesla. It's not an isolated Tesla problem at all. And then in 2026, we return to quite substantial growth on admittedly a slightly lower baseline from 2025, 52% growth rate. And then we take off after 2026, basically, and it goes quite bananas. And I think it's part of the reason why Elon had this all hands-on meeting and said, don't sell your Tesla stock. You have to be patient. That's kind of the thing here. And then we go to adjusted shareholders net income. So here I skipped a few things. We now jump from operating profit right to adjusted shareholders net income, and the reason is the items that are in between these two, they're really not that interesting. This is all also fully modeled out. Interest income comes from Tesla's large cash pile, which is actually quite an important element right now, because the interest income Tesla earns on its huge cash pile is quite substantial in terms of
Mm.
percent contribution to total earnings. Then there's interest expense. A lot of people think Tesla doesn't have debt. This is kind of true, kind of not. Tesla doesn't really have corporate debt, but Tesla has a ABL program, which is standard for automakers, where it basically bundles a bunch of auto asset and securitizes them and sells them to investors. It's very common to
Mhm.
release a little bit of cash, and Tesla has a bit of that, excuse me, and there's some associated interest expense on that. Also not a needle mover in Tesla's case. And other expensive income, this is mostly FX movements, because Tesla has, for example, a huge business in China, and there's a lot of money sitting in China all the time. And Tesla is not withdrawing all this money every quarter into the back to the US. So this money sits in China, but for every financial report, they have to value this money. And depending on how FX rates move, there's a gain or a loss, and that's reflected in that line item. And then Tesla's tax rate is around 20%, in line with S&P after last year's tax regime change. But anyways, again, too much detail we don't need to get into. There's a tiny bit of non-controlling interest you need to deduct, and then you arrive at the reported GAAP shareholders net income. But this is not the relevant metric for valuation, because you need a more normalized number, and that's why you want to look at the adjusted number. In Tesla's case, Tesla only really adjusts for share-based compensation. For example, General Motors adjusts for pretty much everything, all kinds of restructuring charges, yada yada yada. Tesla, for example, does not adjust for restructuring charges. Um, and luckily, Tesla took my advice. In Q4, I said Tesla should adjust for the Bitcoin movement. They
Yes,
finally did so. So they
that's right.
removed the Bitcoin movement because they created enormous volatility. And anyways, so then you arrive at the adjusted shareholders net income, and that is so what you look at this chart. This is adjusted shareholders net income, and you can see that in 2024 Tesla generated 8 billion. In my forecast results in 7 billion, uh, but I do not. Yeah, it doesn't really matter anyway. Tesla's Bitcoin holding in my modeling is neutral. There's no gain, no loss, and again, now Tesla adjusts for it, so it would not be reflected in this chart anyway. Because I'm anticipating some comments to this video. What about Bitcoin if it goes to 200? It does not affect this number. Okay, so with that out of the way, we're getting quite close to where we actually want to get to. So now we need to turn the adjusted
Right.
number to an earnings per share number. I skipped the step where I modeled out the Tesla's number of shares outstanding. Tesla, because of its startup origin, has a very high, I wouldn't say very high, like normal for Silicon Valley or company originally, it pays a high stock compensation, and this creates on an ongoing basis some additional shares. So you need to account for that. This is not a huge driver, creates maybe off the top of my head, maybe 1% dilution per year. But anyways, this is also reflected in this forecast. So when you take the forecasted number of shares and you divide the adjusted earnings, so these numbers, you then get to the earnings per share number here. And just one little technical detail: you want to do it on a diluted basis, because because the diluted basis is consistent with the share price. If you use basic, you're inconsistent. But anyway, just side note. So you arrive now at the correct EPS to use for valuation, and this is the diluted non-GAAP EPS. And then there's another step you have to do. You have to turn the quarterly numbers and just flip back. So this is the first version of the chart, and then now you have the second version of this chart.
Hmm.
You have again the exact same numbers, but on top, this kind of little curve here, dotted curve, is and you see down here the axis has changed. Now you see these months, because these months reflect the reporting months. For example, on April 2022 2025, we got the last quarter reported from by Tesla, and Tesla reported 27 cents per share diluted non-GAAP earnings, and from that point you need to count the next 4 unreported quarters to get to the current next 12 months earnings numbers. So from today's perspective, the next 12 months EPS based on my model is 2.25. So I hope
Gotcha. I
that is
understand. I
clear.
understand. Yeah. Okay.
Okay, perfect, perfect. Because this is a key bridge you have to take
Yep. Yep. Yep.
to understand valuation. It's always forward looking. So all this historical stuff, nobody cares at this point,
Yep.
and it's all about forward looking earning. And now we get kind of to Tesla's. So how can the stock be so high?
Hmm.
And you see it here in this chart, because yes, 2025 I forecast just under $2, not outstanding. But then in 2026, we get already to
Right.
$2.6. So it's a massive increase, and it's even ahead of last year, and just a bit below 2023. But then it really takes off in 2027, and then it goes bonkers in 2028.
Wow. Hmm.
And 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 this is kind of the key reason, because there's a huge carrot right now dangling in front of like in Tesla's future, and
Hmm.
that's why the stock is trading so highly. Because when you then think about this, okay, what does this mean in terms of share price appreciation? This is where we then have to go to the next step. I now take these
Yeah.
next
Anyways,
12
from
months.
$2 per share to $8 per share in 3 years. That
Yeah,
is
yeah, exactly. That's the crazy thing about it.
That's
And
actual, yeah. And then you go back and go, okay. And what you've been pointing out so often is that you have to understand that the market is forward looking. So the
yeah,
stock price is thinking 12 months ahead. And so you've
yeah,
got to like remember that, okay, yeah, even though the actual is going to skyrocket in 2028, we don't have to wait that long for the price, some of it to start showing up
yes,
earlier. Yeah.
yeah, yeah, exactly. And when you have a situation like this, often what investors do, they move from a 12 months multiple to 24 months multiple. But
Okay.
I
Yeah.
didn't add this part to this analysis, because I think this gets a little too much,
Yeah. Yeah.
and I think it doesn't add too much additional sort of input. And that's why I kept it on this basis. But I just wanted to mention it, because this is also a thing that is used by institutional investors. And
Mm.
so I just jump back first. So again, so these top numbers, these are the numbers that you see here. The lines, each line, each vertical line, yes, each vertical line mark a quarter, and the dashed line now turns the 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 number that we have moving only every quarter into a daily number,
Mm.
because we want to project like share price, right, on a daily basis ideally, so we can project a corridor. This is the only purpose of this chart. This is just the transmission or the conversion mechanism. This is
Mhm.
no effect on valuation, nothing. It's just the necessary step you have to do in order to create the following visual output. So I just want to point this out. So doesn't add anything to the valuation. It's just a technical slide effectively. Here is the multiple slide we already discussed. And now this slide brings everything together. So you apply the multiple that you derived here to the earnings that you derived here for each single day. And the outcome is what this chart shows you. So this is where we basically started. And I jumped to this version. This is the exact same slide, just zoomed in a bit.
Nice. Thank you. Yep. Okay.
And it makes it a lot easier to read, and also sees you significant volatility. And like one key observation is, beyond what we already discussed, how this works with the standard deviations and all this stuff, is that the forecast, like this methodology forecasts the share price in this gray shaded band, and you can see it. It was quite okay for the last year, and the reason is because I'm using the last 1 year median multiple. That's the reason. and that's why it's so off. And this shows you how the multiple moved over time. So the biggest weakness of this methodology, let's assume my earnings are perfectly correct, then the biggest driver of variance to my forecast will be the multiple. So that's the crux. So when we go back to the multiple, so what you have to think about is, okay, let's say AJ's earnings are picture perfect forecast of what's going to happen. uh, will this multiple stay, or will it
Mhm.
go up, will it go down? That is the
Mhm.
question. That is a
Mhm.
massive driver. So the one first big question. And then obviously, then it's about the earnings. And I think at this point, I think we discussed enough about sort of the mechanics of the share price projection, and also the earnings and the multiples, and we talked about the business high level. And given kind of the time in this video, because we also want to discuss the cyber cap model and how this is reflected in this entire valuation. So maybe we jump now to this important business segment, because as we looked at earlier, by around 2028, this will become a major part of the business, and that's why
Before we go to
yeah,
Robotaxi, though, go back to your stock price. I just want to clarify a few things. So go back to your stock
yeah,
table. So by the end of this year, 2025, December
yeah,
2025, you kind of
yeah,
have the stock. I think if I look at it carefully, it's going to be in that band of around still 300. It's still going to be around the 300. Now, of course,
yeah,
you were saying it depends on what happened to
yeah.
P. Of course, it depends P, but that's where you're saying the end of this year is around 300, right? But in a
um
previous show we did, you were thinking it might go to 600
yeah,
because if you go to 12 months after 2020, December 2025, you go to December 2026, you look at that earnings, all of a sudden they go, oh, it's going to jump.
yeah.
And so therefore
So
the PE could jump up, or what do you think?
yeah, so at the time of the prior, so this was, just a quick recap. So this was post the Q3 2024 results, which was a stellar print. Was basically awesome numbers across the board, and Tesla released those numbers end of October 2024, and couple of weeks later, I generated my forecast based on this great set of numbers, and the key thing that has changed is the following. At the time, I used fully Elon's outlook. Elon guided at the time that 2024 would see
20%
some
growth.
slight volume growth.
Yep.
Didn't happen.
Didn't
Elon
happen.
guided for 20 to 30% volume growth in
Hmm.
2025. I
Right.
don't think that's going to happen.
Agreed.
So the biggest delta between my old forecast and now
Gotcha.
is that I now discarded
Yeah.
this
The growth. Yep.
guidance by
Yep.
Elon and
Yep.
moved to assumptions derived from what I can observe in the auto market. That is
Yep.
the primary driver.
That makes sense. Okay.
Yeah,
So right now, your prediction for the end of 2025 is around the 300 marks, just flat.
yeah. So it's actually here in the headline.
Oh, there you go.
This,
Sorry.
yeah. So
340,
I guess
370,
I make it easy. And actually, by the way, this is formulaically linked. So whenever I
yes.
change something in model, I
350.
make sure.
Okay. That's not terrible. That's, I mean, it's not all
Yeah,
time highs, but yeah. Okay.
yeah. But of course, keep in
So
mind,
what's the PE? 70 or 120? What was your PE there?
the PE is here. That's the 120,
You are
because that's
using the
the
120. Yep. By the
yeah,
end of the
that's the
year.
sentiment
Okay.
sentiment over the last 12 months. So
Yep.
again, I try to take myself out of it. I don't want to start opining on the multiple, because as soon as I do it, this is not quantitatively derived anymore from the market, because
Hmm.
ultimately it's not about you, me. It's about
Hmm.
what the market pays for it. And
Hmm.
apparently Tesla investors are right now willing to pay quite a premium to have a chance to take part in these massive earnings that are
Yep.
incoming in. They're not tomorrow, but
Couple
the
years.
future looks quite bright. And
Yes, it does.
when you look at other phenomenal stocks like, Apple in
Yeah.
2007 summer, when the iPhone excuse me, was presented, it took a little to really start printing, but it wasn't. it was of course a much faster ramping product because it's like a relatively cheap consumer product compared to vehicles and bots and stuff. But still, I think it's often important that you just zoom out a little bit, because in the grand scheme of things, 3, 4, 5 quarters isn't really that much.
Yep. Okay. This is great. Thank you. Yeah.
So, Herbert, shall we move on to
Yes.
CyberCam,
Let's do
or
it.
you want
Yeah.
to?
No.
Okay.
Yeah. That's great. Yep.
Okay. So CyberCam, again, in this presentation, it's part of the what I call the Tesla ride-hailing segment, and the key thing here is obviously, how fast can Tesla pump out Cybercams. So this is what the top chart shows you. It shows you the autonomous vehicle production. And I on purpose didn't call it Cybercab, because at some point there will be other autonomous vehicles, I'm quite sure. Maybe
Yes.
not in this time frame, but you get the bigger picture. So I expect like a very small kind of trial productions from 2026. This might be a bit early, a quarter or so, but ultimately this is not going to be a huge needle mover, and I expect like a slow ramp for that reason, and then it goes quite quickly, because we know from Tesla that they will have built the production lines for very high volume, so the ramp should go quite quickly, and I might be conservative, but ultimately for the revenue generation of the ride hailing network, of course it's not the vehicle production that's important, it's the average fleet size, because all these vehicles that are being produced quarterly, they add to the fleet, so it's cumulatively growing, obviously, and this is what this chart shows you. And so I expect, at the end of Q4 2026, about 47,000
47,000. Yeah.
47,000 exactly, average
Conservative.
fleet size, and
That's
again,
at
so
scale. Hmm.
that
At
yeah, so
scale.
it's basically still ramping at this pace, and you can see how it goes kind of exponential, kind of
Hmm.
in 27, 28, and we'll exceed 500,000 vehicles sometime in 2028, based on my assumptions. I
Okay. I
might be
just want to
conservative.
make sure though that I hope you agree that your assumption for Cybercab scaling as it scales should be faster. It should be faster than any other product that Tesla's ever made, cars that they ever made. That's all.
Yes, yeah, but um, I always try to. Okay, the problem is I covered the stock since IPO. Stock IPO'd in 2010, so I'm approaching my 15-year anniversary soon, in just 2 months, 1 month actually. And so the bottom line is, uh, Tesla has a strong track record of delivering, but Tesla has also a strong track record of being slightly late. And
Yes.
just to account for that,
Yeah.
because like as we just discussed, my $600 price target was too bullish. Why? Because I bought fully into those
Yes.
assumptions,
Yeah.
even though I should have known better, because I'm covering the auto market,
Okay.
and I know that it's extremely difficult right now to sell cars, because everybody is struggling. Every try is trying to push their product. But anyways, so that's why I want to be
Okay.
slightly more conservative,
Okay.
because when it comes
Okay.
around ride hailing, and you're having like here,
It's a
the
brand
bigger
new
thing is,
factory, brand new car, brand new process, brand new
yeah,
materials.
yeah,
I
yeah,
get you.
yeah.
Yep.
Take
It's like
take
the
take
Cybertruck.
exactly
Yeah.
all these boxes, and the other things, like bigger picture from a investor perspective. In capital markets, you're if you have a company like Tesla with such great potential, you I don't know whether any investor has ever been rewarded to be overly optimistic on a great opportunity.
Gotcha. Understood.
Because if it's a great opportunity, you're going to invest anyway, right? So what's the use of being on top of that overly optimistic? I try to produce, at least from my perspective, as realistic a forecast I possibly can do, and I
Okay.
try to take my my sympathy for the company, for the management, etc., out of it. Just try to look at realistic. I know on X there are all these $5,000 or $10,000 by 2028 price
Mm,
targets, but
mm.
I'm not amongst those analysts. So,
Okay.
as I come from a different place. So I just want to point this out. I might be horribly wrong here, but I think it pays to be slightly conservative on these things. So anyway, so this is kind of how the fleet ramps up, but this is only one critical input. The other critical input, and here the top chart, I'm just carry over the same numbers, so you have all the
Hmm.
key numbers on the same chart.
Hmm.
The other critical input is the APM. So this is and I explain it here in the bullets. This is the average paid mile. So this is not
Hmm.
how many miles the vehicle drives every day. It's for how many
Hmm.
miles you get paid. It's a very important distinction, because people look at it as, oh, it will drive more than 107 miles. Of course it will, but it has to pick up the customers, and we know, and there's a lot of research on this topic in the taxi, in the ride-hailing world. Depending on the market, often sometimes 50%, and in some markets even more than 50% of miles are driven without the customer. It's just to get the customer and then drive them to the destination. And these miles are in the industry called deadheading miles. The term Tesla used in its Robotaxi presentation was, I think, empty miles. So these are all the same thing, and we discuss it in a moment why they are so important. And so anyway, so when you have the average fleet size per quarter, you have the average paid mile per vehicle per day. You can then easily translate it into revenue, and this is what the bottom chart shows you. But of course, we now have to look at the cost side, because this is only revenue. So this is so now I have to jump, sorry, a bit further. So to these charts. Okay, these chart now talk about the ride-hailing cost side. So we just established the revenue. So average fleet size times daily paid miles, obviously times the price, gives you the revenue. So now we need to go to the cost. And in the cost side, there are two very important distinctions. There's the cost per mile driven. And this is exactly what the sticker says. So every mile the vehicle drives, how much on average does one such mile cost? This cost per mile is different from the cost per paid mile. The cost per paid mile
Hmm.
is okay. When I give you an example. So if I pick up a customer and the ride is 5 miles, and let's say I have a very low empty miles ratio, let's say 20%. Make it easier with right now. So the customer travels, let's say, 4 miles. When the heading ratio is 20%, I need to add another mile. So I drive 5 miles, but I
Hmm.
can only charge
Yep.
four
Hmm.
for the customer's destination. So what's the relevant cost? So I need to convert the cost per mile into
Hmm.
the cost per paid mile, and this is
Hmm.
where where this slide comes in. I'm sorry, I'm jumping here around a bit, but at the end, I hope it will all make sense. So the CPM, the cost per mile, is what we derive here
Hmm.
on this slide, all the details, and then we need to convert it into the cost per paid mile. So you can see in the middle chart the deadheading assumption. So
Percentage. Yep.
in the beginning, I assume
50%.
50%.
Agreed. Agreed.
And the
Yeah.
reason why it's so high is there is low
Yeah.
density, there is low customer adoption. It's a brand new,
Hmm.
service,
Hmm.
and even in strong markets, it will take a while before
Yeah.
people make it like a habit, etc. But over time, it will come down, and as network effects kick in, the dead heading ratio will come down quite a bit, and will approach, like, I expect a lower ratio than what is observable right now in key markets. And I spend a lot of time on this metric because it's a key driver of profitability, deadheading share. I mean, and then when you want to go from the cost per mile, so the top chart, to the cost per mile at
Per
the
paid mile.
bottom, you simply have to divide the top number by the middle number,
Yep.
and then you get to the cost per mile that you have to charge against each paid
Yep.
mile.
Yeah.
That's the key thing. And the reason why this is so important is a few years ago when all this ride-hailing debate started about robotaxis, etc. I remember some famous Tesla community investors. I will not name them right now. They forgot about that. They
Mm-hmm.
only looked at the CPM. They completely ignored the deadheading part, and that's why their projections were completely off. And this makes a huge driver, a huge difference. I just want to make this clear. Anyway, so with this out of the way, let's go back real quick to the top number, the CPM, the cost per mile. This is a very important metric, and this is also where we can see why the cyber cap is brilliant
Mm-hmm.
for big, and why it's going to wipe the floor with the competition.
Mm-hmm.
The cyber cap's true strength, and you can see this in this cost breakdown, is the production cost. The production cost is very low, and the production cost is enabled because it's a two-seater. It's a small and a relatively light vehicle for a electric vehicle, and it doesn't have an expensive sensor suite. So these are like the key competitive advantages in addition to the software, of course. And the
But
reason,
AJ, the
yeah,
Waymo CEO came out and said it's irrelevant the cost per vehicle because it's it's amortized over 15 years, whatever, 10 years, whatever they
yeah,
do.
that's
You know what I mean?
bullshit.
Okay, that's what
That's
I want to
bullshit.
ask you. Per
That's complete
mile, it
bullshit.
still shows up in per mile. Yeah.
Yeah. I'm sorry, but he can tell
Okay.
this like the noob investor, but not financials pros like myself. I'm
Okay.
sorry.
I
It,
wanted
it
to
sounds
hear
like
that directly
boasting,
from you.
but it's true, and I can explain why.
Okay.
Um, if you have, so for example, just be clear, in my modeling here, I only assume a very short useful life of 4 years for these vehicles because they drive a lot of miles. They're
I see.
driving over 300,000 miles.
Yeah.
And the thing is, customers don't like riding in
Older.
like
Yeah.
old,
Yeah. Beat up
dirty,
cars.
smelly,
Yeah.
whatever. I have a refurbishment assumption in this model, so I
Gotcha.
account for the fact that Tesla has to, and for example, it's where's it?
Makes sense.
Here, interior
Yeah.
refurbishment.
Yeah.
I account for the fact Tesla has to refurbish these cars at least every 80,000 miles,
Yes.
because otherwise people they would simply that I mean, if you've been to places where they don't have nice cabs, dirty
Yeah.
cabs, you know how disgusting it is. And
Mm-hmm.
people with money, they don't put up with this stuff.
Yes.
So this is a key competitive advantage. Tesla knows they're not stupid, and so what these people put out, this is just for the. I have to be blunt here, for the stupid investors to keep like a carrot in front of them, because they know they are weak on the cost side, and they know that the cost side is ultimately deciding the ride hailing war that's coming. At some point, they will also get to a competitive FSD because of massive compute increases, blah, blah, blah. But the point is, the cost of the vehicle is still, will be at this point, the key
Key
competitive
differentiator.
advantage.
Gotcha.
And that is what they try to cloud at the moment. And
Mm-hmm.
I can prove it mathematically. And in this model, I partially show you
Mm-hmm.
why.
Mm-hmm.
And when you look at this cost breakdown, I calculate per mile driven. Tesla is just under, let's call it 16 cents.
Yeah.
It will cost Tesla, and I have I think much more realistic assumption, because 15 years completely ridiculous. For example, in most European countries, the average vehicle age is less than that. It's around 11 or 12 years, and and when you look at like rental cars in Europe, the successful ones, they switch cars every 2 to 3 years, because they
Exactly.
know
I was going to
if they
say.
have older
Yeah.
cars,
Yeah.
the customers just move to the next one with cleaner cars. So it's
Yes.
like completely silly to
That's
to
true.
to claim 15 years. It's absurd. And anyways, so I ranted long enough on that point. But anyway, so when you then do a proper depreciation schedule, etc., account for all the accounting stuff, then you arrive for the accounting, sorry, the depreciation charge at 7.2 cents, and you see this makes up 45%
It's
of
the
the
thing that
total
matters.
cost.
Yeah.
And when you look down this column, this is ordered by impact.
Mm-hmm.
You can see that the depreciation and cleaning, oh, coincidence, make up almost 2/3
Yeah,
of
yeah.
the cost. And now you might wonder, oh, why the F did Tesla make this stupid robot where it
To
showed
clean.
us a video years,
Yes.
not years, but a year before the robo, before Cybercab would hit the market? Because they did exactly the same calculation that you see in front of you.
Yeah.
And they figured, oh, cleaning is a big deal, and this is a big cost driver, so we better put some resources into it to figure out how we can make
Automated.
this as robotically as possible.
Yeah.
Because I mean, you have friends, Herbert, some people are just super messy,
Oh
and
no. Yeah, this is going to be
they eat,
disgusting. Yeah.
they
If you
eat
rent
snacks,
something, you don't give a crap. Even I, not that
yeah,
I would do it, but I mean, some people would
exactly.
just like their
And
behavior
then
changes when it's not your car.
exactly. And then obviously Tesla, they have like big vision and global vision, and I'm sure the smart people at Tesla, they also considered cultural differences, because
Sure.
and I don't want to shit on Indians, but I've been to India, and littering is a thing.
It's a
and
thing. Yeah.
and
Yeah.
Indians know what I'm talking about, and you
Hmm.
need to make sure you have a good automatic cleaning system. Otherwise, it's not going to end well. And so Tesla is very smart. And when you look at the details of the Cybercab, the seats and everything, it's made in a way that it's easily cleanable. It has very
Hmm.
simple. It doesn't really have any stitching where stuff can get stuck. Anyway, we don't need to get too deep into the rabbit hole. But the bottom line is Cybercab is brilliant and is totally optimized for cost, because that's ultimately long term the differentiator. Because Elon knows, when you look at the scaling laws, and how quickly and how much cheaper compute gets, Elon knows that in a couple of years, and with synthetic data generation, blah blah blah, he knows that some Chinese company probably, and probably some other Western company, will come up with some FSD that is competitive, at least in some local markets. And I'm sure, as always, some investors, they will be happy to burn billions in cash to pump up the next Tesla, or the Tesla, the Android to the iOS,
Right.
if you will. So
Yeah.
this is going to happen, because this always happens in these industries. So, and Elon knows it. He's smart, and that's why he's focusing on what is like a lasting competitive advantage. But of course, at some point in the future, people will also try to replicate that blueprint. But I think by that time, Tesla has massive network effects, like with the supercharger network. Um, it's very difficult now for any supercharger network provider to grow, because Tesla's is just so good, and it takes basically the oxygen away from them. And that's why, exactly as I predicted Tesla would start with a low price strategy. People talked about $1.50 or some silly stuff. I argued from the beginning they will shoot for much less than $1, because this drives
Right on
mass
the first day,
adoption.
day one.
I predicted it long before it was announced, but then later, like in probably 2023, I argued I argued Elon would go for a low price strategy,
Yeah, I think so
because
too. I've been saying the same thing. I can't believe some people are thinking that they're going to charge exactly what Waymo and Uber is charging, $2 to
no,
$3 a
it's
mile.
so
Yeah.
it's not just like out of thin air, I guess, but it's like, if you go like from first principle, it's the rational strategy. Because what happens if you have a low price strategy is, one, you have mass adoption, because
Yes.
depending on where you live and what vehicle you drive, if you own a vehicle already, you pay everything considered roughly $1. Of course, it varies if you buy expensive, blah blah blah. But the bottom line is, if you go significantly below $1, you create a real incentive for people to really consider
Yeah,
a car-free
I'm just talking
lifestyle.
about whether or not that is first year, or we're talking about future. Of course, they're going to go future. What I love about this analysis is that this shows me. Thank you for doing this detail. That it's actually possible when Elon says we might be able to do 25 cents per mile at some time in the future. It's possible if you've got 16 cents per mile cost per mile. Maybe that is
If
something that's
um,
achievable in the future. Yeah.
it, okay, first of all, two things. If we get like serious network effects, and we can bring down the deadheading mile
Miles. Yeah.
ratio,
Yeah.
that is the key enabler. That could make it feasible. But then also when you talk about 25 cents in
Yeah.
today's dollars, because
Yeah.
if this like a couple of
Right.
years from now, you have to account for inflation, blah blah blah. And yes, it's feasible, but we need massive network effects for that, and we really need a change in society to go basically car free, which is
Yeah.
totally possible, because car is if you really think about it, is basically absurdly expensive in many
Yeah.
ways. If you think
It's
about
ridiculous.
garage parking, blah blah. Anyway, so the bottom line is this is a really interesting opportunity, and so the cost is really the strategic advantage that Tesla has, and I think let me think whether there was something. I'm sorry, I forgot about this. This is just a projection. This looks like static, but this is actually moving. Um, I'm just thinking whether there's something else we should touch before we wrap up. But I think, yeah, why don't we end on this slide? I think I pause here. If you have any final thoughts, Herbert, that you'd like to discuss,
Well,
otherwise,
first of all, I've never seen any analysis this detailed. And what the main comment you've already addressed, which is the number one argument people make, is that the cost that doesn't matter, right? That the cost for vehicle, even though if it's 100,000 versus 30,000, it doesn't make a difference. And you've outlined that clearly, that will make a difference in the cost per mile. And then that, because the cost per mile is going to be the number one driver of
yes,
which service is going to succeed or not succeed. It's almost
yes,
always dollars that the people most care about. And then I think and this is all still very much on your conservative growth. Did you factor in that people can put in their cars into it, or that they can use Model
yes,
Ys, not just
but
cybercabs, and that they can
but
use, by next year they
this
can add consumers.
this is
Yeah,
modeled separately. This is a different
right.
segment. I
Owner ride
treat this
hailing. Okay.
because this is like from a financial perspective, it's really a software business, pure software
Yeah.
business. Tesla is
Yes.
providing an app, and you can contribute your vehicle,
Yeah.
and it's all remotely. The owner takes care of the cleaning of the car. If something
Gotcha.
happens, Tesla just is the middleman matching the supply with the
Okay.
demand, effectively takes a cut. It's basically, I call it the, the Tesla tax at this point, and like what Apple does with the app store, basically.
Okay. Can
And
we just go back to your stock chart? Go back to the stock chart,
yeah,
and let me
yeah,
ask you this question, because people have. This is the other reason people are saying to me that in June, when they actually do just 10 to 20 cars, and then in a month when they grow that, that alone could see a stock jump, because you're finally putting numbers and you got details on the program. And others think that no, but by December, once they truly start rolling this out to hundreds, then that's when the stock might jump. And then there's others still who will say, no, you have to wait until the second half of next year, when the actual earnings actually do move the needle. That's when the stock will jump. What's your opinion on that?
um, yeah, this will not be very popular, but it's basically what I observed. So I shared, probably I should repost it. I did a Tesla key events analysis.
Yes.
So I looked at Cybercab unveil, new Model 3 launch, Tesla AI Day. It's the initial cyber truck unveil, a bunch of other of these key Tesla events, and what you see is in most cases, it's a buy the rumor, sell the news type situation. So uh, so basically, there's often, I don't want to use the word hype, but because it's very negatively loaded in the Tesla community, but I use it in a neutral way. So please
Mhm.
be angry at me. But there's often, hype building up, and these are not secrets. Everyone on this planet, pretty much, but at least everyone in Tesla community knows, at least for 6 months, that there's, it's launching in Texas in a couple of weeks from now, probably. So what is not priced in yet? I'm asking.
Exactly. Agreed.
It's all priced in. That's the point. For example, when the Tesla Model 3 was leaked, the new one, and so we saw some movements a couple months before, so there's a lot of noise. But then when it launched, there was absolute there was kind of a soft launch late September, September 2023. There was no movement, no reaction, because it was all already anticipated, and there are a bunch of other events like I mean, we don't have to go back this far. We just go back to the 1010 event.
Yep.
Stock sold off. It moved. It had strengths into the event, but then on the event it sold off. So again, we could go to bunch of examples, and I should really repost this analysis because it's very interesting. But the bottom line is, in most cases, it's a sell the news type of event, unfortunately. However, I'm optimistic we're not going to see like a significant drop in the stock. I just think, unless we have like a massive market rally, or Trump puts out another post where he says buy stock, absent such events, if like a boring market day and it starts launching, I don't expect massive movement, because the work we've looked at here, modeled everything. There's just not that much earnings coming out. The problem is that the owner, or the small scale rollout with Model Ys and maybe Model 3 is probably just Model Ys. This will not need move
It's
the needle.
nothing. Yeah,
It will
it's a Waymo.
probably,
Oh, they're doing what Waymo's doing. That's it.
yeah, and Tesla, of course, they're not stupid. They will be super careful. I would not be
Slow.
surprised if there would be even some kind of shadow pilot
Yeah.
that is monitoring. I don't know. I imagine like a guy with 5 screens, and each screen has like a vitals of each car, and some,
Yes.
I don't know, live stream to make sure nothing stupid happens. Look, if I was Elon, I 100% would make sure the system is in place, just to make sure because if there's something horrible happens, this could have like a massive impact. So I would happily spend 100 million to make sure the 6 months we have like a system in place as a safeguard. But anyways, we don't need to talk about horror scenarios here. I expect like a smooth rollout, because Tesla will be smart. They will do it step by step, methodically, and then by next year it's basically tuned to perfection, and then we have rollout of Cybercab. This is right now my base case.
Yeah, I agree with you. I've been saying I think January of 2026 is when the stock might pop. And why? Take a look at your own numbers. You saw the jump in earnings, margin jumps in January of 2027. If the market is forward looking and they start realizing that, that's when it might jump, right?
Yeah, and exactly. So when we look at this chart, so it's the vertical gray line is the end of the year exactly, and as you say, in early 26 it might jump. This is basically exactly in line with my forecast, and keep in mind this is a forecast. It will not be 100% accurate. So this might be, let's say everything is roughly accurate, but you also have to keep in mind the timing. There might be a little bit of pull forward, or depending on the overall market, it might react a little later to it. So you always need to factor in a couple of months plus minus to everything you see here. You should not, I mean, this type of analysis should not be conceived as like, okay, on that day Tesla will hit that price. No, this is more high level to give you like on a systematically derived, in a consistent way derived or method, sort of a corridor where things could trend. This is kind of this is basically
okay. Another comment on the PE ratio, the multiple, the multiple. You said it was the median's 120.
Yeah.
Would that median change as people start realizing Tesla's no longer just a car company, but they're now a robotaxi company, or they're a robotic AI company? Could that rate change up or down, or is it so high already that it's already built in?
it is a very good point, and I'm glad you asked the question. So that the multiple captures all of that.
Okay, it's already
The,
built in.
the, the
Yeah.
multiple, everything you just mentioned, and a lot more, like
Yeah.
the Elon running the shop,
Hmm.
amazing leader, all this stuff,
Hmm.
everything you can imagine is reflected in multiple. This is like technically, we could have a long academical debate why this is, but this is ultimately what it comes down to. So all this future is already reflected, because the simplistic argument is, how could it otherwise be possibly so high?
Yeah. It's
So
too high, and that's why. It's just that some people say, well, only when they launch Robotaxi do they actually prove they're actually able to do it, and then only then could then we start valuing it more. But you're saying, well,
um,
that's not
I,
true.
I
They're
I
already
think it's
valuing it
like
now.
I'm sorry, but this is like a silly argument in my view. I mean, just go on X, or just when you are in the US, just take a test ride. I
Yeah.
mean, as Elon said, the
Yeah.
only people who
Yeah.
still
To
doubt
debate
it
it. Yeah.
are the ones who never tried
Never
it out.
tried it.
And to be honest with you, even if you have no chance to try it out, just, I don't know, on a quiet Sunday when you have some time, go to YouTube and watch a bunch of these videos, and you realize it's either all fake, or this is crazy
Yeah.
amazing. And I don't think it's fake. So but
Yeah.
I am joking, of course, but the
Yeah.
bottom line is, in my view, the technology has been proven.
Yeah.
But as Elon said many times, you just have to get it to a quality level that
Hmm.
it's superhuman, because we humans, we accept that humans run
Well,
over another
other
human.
human, but they won't
What's the
accept. Yeah.
statistic? Every 600,000 miles, like
Yeah. Yeah.
bodily damage or something.
Yeah.
And but we will not accept that a bot will run over, after the exact same amount of miles a
Yeah.
human. We want the bot to be at least 10 times safer. Why
Right.
that is, I don't know. But because I would already be happy if it was only 2 times
Exactly.
better,
Me too.
because it would
Yeah.
already save lives. But this
Yeah.
is just the irrationality of humans and the emotions that go into these things. And
Yeah.
then Elon knows it, and that's why he's always talking about it must be 10 times safer, and that's why they're shooting for it. Because again, we don't want to talk about horror scenarios, but mathematically, it's almost, it's no, I could walk you through the math, but I skipped that part. But the point is, it's mathematically virtually impossible that there will not be a horrible accident within the first 1 or 2 years. This is like the probability that it would not happen is basically astronomical.
Yeah.
And
It's
it's
yeah.
unfortunate reality,
It's
but
gonna
you cannot
happen.
make
Yeah.
this like perfectly safe. I mean,
Hmm.
think about airlines. Flights have become incredibly safe,
Hmm.
and but still, once in a while, you have a crash. And the same is going to happen with robotics, unfortunately.
Yeah.
But it will, by that point, it will have saved already probably thousands of lives that would have been
More than that.
killed
Yeah.
if humans would have driven.
Agreed. Wow. Okay. Well, AJ, thank you very, very much. Any last comments on your side? But I think that you covered this so well and so articulated. And of course, the
Uh,
details. Yeah.
I think the final comment is, I think I'm an investor, so this is basically what I'm sharing is what I do for my own investing, and I think that Tesla will have, a very bright future, and things are really looking good, and this could be an enormous opportunity.
Thank you very much. First of all, thank you for sharing this data. You can see how much work you put in this. And again, very few others put in this much work, this much detail. And as you were going through it, I had to say, I felt very comfortable with your assumptions. You thought of a lot of things I wouldn't have thought of, and it makes me feel more comfortable. But again, this is just you. This is not financial advice.
Uh,
People need to like do their own research.
but one final comment, maybe we actually just touched the tip of the iceberg.
True. That's true. You got a lot more work to do, dude.
Yeah, there's some
So
obsession behind it.
I
What was
gotcha. Yeah. Okay. Well, again, thank you. I liked your logic and you put it together. You can follow AJ on X at ALOJOH. ALOJOH. I'll put that in the description. And please subscribe to him. We need to be supporting work like this. And you saw there, he's fairly accurate. So it's worthwhile looking at what his thinking is. Thank you, AJ. Thanks, everybody.
Thanks for having me.
Bye-bye. I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.